So you're going to be working from the UK next week. That's exciting.
Yeah, I can't. I'm thrilled. I'm so grateful to be able to go and meet with everybody. I'm gonna try and find the best fish and chips. I've learned that the last time I was in London, it was back in January. The curry sauce and the mushy peas are the key. Like, you gotta have it. It takes it from like a 6 to a 12 in terms of a scale. Like, the curry sauce and the fish and chips is like a game changer. I'm already thinking about it. I'm so excited.
All right, that's good. Well, then you're going to want to be thinking about things.
Great transition.
In terms of cable.
Oh,
so,
for sure.
Again, cheaper cable is better for you. A lower sterling or cable price is a stronger dollar. So you get more bang for your buck. So again, last time,
not looking
it's
good
funny.
this morning. But
I was in the UK when sterling was over $2, so everything was really expensive, and I was also there when it was $1.12, where things were relatively cheap. So, it's funny where in almost the rest of the world, currency is part of our daily lives. Because if you're in the UK and you're looking at things in Europe, or you're working in Europe back and forth, that dynamic's very important throughout Asia. Whether you're in Japan, Australia, or wherever, you're looking at currencies. In the U.S., it's such a big country. We're very inward focused, and we just take that the dollar's the dollar and things cost what they cost. Understanding that the world works within this mechanical exchange of different currencies at different times and different values is an important concept. And one of the things I always tell people when they start looking at diversification, sure, having just on Amazon and Google and Nvidia is probably a little big tech heavy. It's better than just having one in terms of diversification. Right. But when you look at diversification, what is some of the biggest exposure you have? Well, if you're trading Amazon and you're trading gold and you're trading T-bonds, you've got everything priced in dollars.
Yeah.
That's a lot of dollar exposure. So while you don't think about it, your exposure to the dollar, whether or not you're trading FX, is present. And a great way when you think about next level diversification is adding FX into your portfolio. Some FX exposure, depending on what you're trading and how you're doing it, looking at it not from a transactional standpoint, like I've got FX, I do business in Germany, so I've got funds coming in. That's a different exercise. For the active individual trader and investor, the ability to diversify your dollar exposure and add non-correlated returns is a powerful thing. Because we know whether it's Amazon, Google, or any number of stocks, or broad-based baskets like the S&P, whether you're using SPY or ES or MIES to trade them, they all have a very strong positive correlation. Currencies are very uncorrelated to equities for the most part, which is good. You want to have parts of your portfolio be uncorrelated to your core portfolio. So part of this exercise is, sure, finding tradable opportunity. And we see a sterling market that did not receive the budget announcement they had yesterday.
Yeah.
It wasn't a fall off the cliff moment like they did 6 months ago, but we saw a lower sterling market, stronger dollar again across the board. So sterling and let's get a little bit more granular here.
I even read something this morning where it's like, is it ever going to end with the dollar, like the dollar strength? So it's like every time I look at things like this, you talk, oh, the dollar's so strong, and it's been that way for so long. It's like almost feels,
It has. And, when you do go out and you look, we actually got awfully close to par, 102, 120. Now, historically, like I said, it was 14 years ago when we were over $2. Lower end of a really large historical range. Absolutely. Are we seeing a little bit of bounce in sterling? Now, when I look at a weekly or monthly chart, I'm looking at it just for bigger picture context. There's not a lot. I mean, you can say, well, sterling's cheap. Over the last 20 years, a lot's changed. It's really not necessarily, short of just a little bit of context, it's really not worth that much in terms of tradable opportunity. But today we're going to talk a little bit. We've got some interesting economic events coming out. So
many.
We did see, let's just get a little bit more. We'll go down to 15 minutes. So we saw a little bit of the movement here. This was the fall off the budget announcement, and then we saw some sterling strength come back into the market. So this is why we look at these news, whether it's the UK announcing their budget package, or we've got the preferred inflation metric of the Fed in about 50 minutes. I don't know what's going to be. I really frankly don't care. I hope it's
Yeah.
different than what everybody's guessing. That way we'll get some movement.
Yeah.
And here's the thing. If you had been able to see the budget announcement package, they are going to borrow a little bit more than what was estimated. That's why the initial sell-off. But if you had been given that information, but we're told you can't get out of your position until an hour, if you were short, you didn't do too well because the market rallied right back. So we're still seeing, as you said, some dollar strength, especially in things. Now, the yen did trade, touched 153.80, almost 154. Down a little bit this morning, sold off a little bit around after the
BOJ announcements.
which we knew kind of they didn't expect anything. We didn't get much movement off of it. Now, you would argue, well, why did the market sell off if the statement didn't mean anything? And this is where context comes in, because we've had a pretty substantial rally over the last 30 trading days. So no news was like, okay, the guys who were long took a little bit of profits. I think we're dependent on two events today. One event today, PCE, and an unemployment tomorrow will give us kind of two tradable opportunities. But you look at the euro. That's euro sterling. Let's take a look at euro US. We did bounce up a little bit today. 108.80 happens to be the 200-day moving average.
Yeah, the ECB, I remember, was like not the rate cuts, like they were talking about that. I don't remember specifically, but not what we expected, really.
Right.
Yeah.
So a little bit of bottoming off those 108 lows. So a little bit of upside trade coming back into it again, but relatively still very constrained ranges. We're talking about, Glenn did the math, I think the 1 month, one standard deviation range, the scalping range, is 28 pips. So a relatively continuing to be inside markets on all these. Aussie and Canada, Aussie still, we're seeing a little bit of bounce in euro, a little bit of bounce in sterling, not so much in Aussie, and Canada continues to probe the upside here. So bigger moves there across the product set. Now, U.S. equities opening lower today. A lot of tech earnings yesterday that disappointed. So we're seeing U.S. equities. I think NASDAQ is, what are we, 100? Are we still up? Yeah, we're about 170 points. 170 handles lower, SPOO's 20 handles lower. So U.S. equities a little bit softer, not having a great impact on, if you were arguing that, well, U.S. dollars rallying because U.S. equities are at all-time high, we're off a little bit in U.S. equities. It's not giving the dollar a lot of relief right here. So it'll be interesting to see. These two numbers coming out will affect U.S. rates. PCE and non-farm payrolls tomorrow. Let's take a look at the calendar just so we can get a sense of...
I also have a question for you, Pete. When we talk about, maybe the dollar, like things not moving as much, maybe with relative to the dollar, do you think any of this could be with the election coming up and people being a little bit hesitant just because they know that's going to have likely a large effect?
I think that's an incredibly prudent observation. You're spot on. What we're seeing in our customer activity and what we see there's going to be a randomness to this election. And, you read these stories, well, if Trump gets elected, these things are going to move.
Right.
Harris gets elected, these things are going to move. In the short term, what's going to move? Not a lot.
It's rhetoric.
It's going to take time to implement any of these strategies. But depending on the speed at which they can count and the closest to the race, I don't imagine we're going to have a lot of certainty Tuesday night. It's going to be a very close race. But we could get a random move of 2 or 3%.
Yeah.
So I think people are like, I've got an opinion, and you could be the contrarian saying the dollar's rallied, euro at 108 is relatively cheap versus the 112. Or, the next step is par, down to 100, 120 in cable instead of back to the 130s. But we've got this random event coming Tuesday. It will impact markets, which means the markets will be thinner, there'll be more volatility, and it could be kind of random back and forth. So as a trader, the first thing I do is I take a look at my size. If I'm not comfortable, I bring it down. So yes, I think part of the reason we're seeing a little less range and a little less volatility in things like FX right now is people are being mindful that there's a randomness to Tuesday's event that could cause the markets to move in either direction, not necessarily stick there, but do I want to have to bear the randomness of the risk.
Yeah.
I actually think once we clear the election and get an outcome, we'll get people a little bit more engaged in markets because you're removing this randomness aspect. So it's a
Right.
good question. So practically from a trader, I look for opportunity. If the market moves, if I get a 200-point move in yen or a 100-point move in euro right now, would take you well past a 2 standard deviation 30-point move. Now, we know statistically that only happens, a 2 standard deviation move only happens 2% of the time.
Yeah.
That it trades outside that 2 standard deviation range. That's an interesting scalping range. So I think you want to take advantage of the opportunities binary events present to you in terms of being able to engage with market. But if you want to carry inventory into it, make sure it's of a scale that you're comfortable with. Yeah, there's going to be some flutter and some range, but I like my core ideas, and I think they're going to work. So it's a good question. I think you're going to see people trade, and especially on the FX side, be a little bit more compressed. Even so, we get this one announcement, and this is the preferred Fed metric. Now we're looking for, previous it was 0.1, 0.3. 7:30 we'll get the announcement. If inflation comes in a little hotter than expected, what do you expect to happen? And this is again a gut check, because we know that markets will have a reflexive move, but long lasting, it depends on market structure a little bit. So we're not making a recommendation here. We're just kind of gut checking somebody new to product, new to the markets, and starting to figure out how do you engage with them. And we're going to do, it'll be fun because in the next couple of weeks, you and I are going to do a little bit more going into the products themselves and talking about what's unique within them. The fact that there are swap rates, and with spot FX, depending on the currency you're trading and the interest rate relationship, you can either get paid overnight, each night for holding that position, or you pay to hold that position. And we'll talk about that dynamic of how swap rates work and how that affects your positions. And those are interesting exercises to really get an understanding around the product. But when you think about inflation, if inflation prints higher, what do you think it knocks on first and then knocks on second?
I feel like it depends on the country, obviously, because in some situations where inflation goes up, then the currency value can also go up because they want it to increase. But here, would the dollar go down? Or would it would go up too?
It's a great, you summed it up for really well, is that for bonds, where will inflation play through? First, the bond market. If inflation prints higher, interest rates, bonds will trade lower, interest rates will trade a little bit higher. Then there'll be a knock-on effect of higher interest rates affecting equities and a more muted reaction from the dollar from an inflation print.
Yeah.
So if bonds trade higher, we could see the dollar initially trade a little bit higher. Euro tests those lows below 108. Cable tests those lows below 128. Whether it sticks, I don't know. None of us know. But it will be a little bit more muted effect. So while bonds could move, if we get a 0.5 or 0.6 and stick, you could get the movement in FX. It's not as sticky a move. So sometimes there's some tradable opportunity there. So that is the exact same thing. And when we go out and we take a look at tomorrow, non-farm payrolls is the thing. So again, a print here. They're looking for 113, 4.1% on the rate.
It was staggering last month, too. Way higher than they thought it was going to be.
Way higher than what's expected. And what's always interesting, too, and this is why they will revise this number again, this previous number. They could take it back down to 100. And it's like, wow, everybody so reacted to the non-farm payrolls number at 730.
Right.
And, well, the actual number wasn't 254. It was 130. So we don't ignore the fact the markets will move. We look for opportunity within that. So same sets here is a higher print will probably lead to the idea that, and again, just a very short macro walkthrough, and I don't hang a lot on it. Interest rates probably will trade a little bit. Yields will trade higher. Bonds will trade lower. And we'll see an initial, if we get a print of 200, we'll see the dollar get a little strength. If we get a print of 30, probably see the dollar get sold a little bit. Whether or not it sticks, we don't know. So it is, again, what I love is there's opportunity for movement, and because it plays through in a little less impactful way, you will get the whip, but a lot of times you'll get two-way action, which as traders is what we want. And when we go through all the pairs we've been focused on, both the currency pairs, both the major pairs, and our commodity pairs, they are all at kind of inflection points. We've had a pretty big pullback from the highs here, just back into the middle of the range of the Aussie. Things like Kiwi, take a look at. Kiwi, again, continuing to be soft. It'll be interesting to see if we get a trade back to the lows or we trade a little bit higher on softer economic news, and whether or not that gives you an opportunity to get involved at either end of the range. Let's do one quick last check in on
The peso. I was looking at that this morning.
This has cleared some ground now.
Yeah.
Okay, so we have spent some time right at 20 pesos to the dollar. We're going into the end of the week and into the election with this trading right near its highs. So this is what I'm going to be watching for through the election and through that. This is an interesting trade. There's a carry aspect to this in terms of the interest rate differentials, but there's also a tariff aspect to this. Now, how long lasting is that? Let's not worry about that. We're not macroeconomists. We're not applying a model. What we're doing is looking at what is driving markets and keeping that into the equation. So this is something that is willing to challenge and trade new highs as we go into this election outcome. So this will be an interesting trade too. We want to keep our eyes on. But a lot of good stuff to do.
Yeah.
We will, if we don't have you next week, we'll have you back the following week, which will be fantastic.
It will be.
And we'll start digging into some of this stuff. So Bridgette, thanks so much for.
Thank you.
It's so much fun to do this with you. We'll see you back here tomorrow. Free non-farm payrolls. Have a great day.